Hey, it's Don Kaufman here at TheoTrade. A quick announcement before we get to the weekend update. TheoTrade.com/Greek. Again, that's TheoTrade.com/Greek. You know, years ago, I started something at thinkorswim, brought it to TD Ameritrade, and now we are bringing it to TheoTrade. We're doing Greek week. That is delta, gamma, theta, vega, everything from beta weighting to position management. If you guys have never been through the Greek week, we are holding a special for it. Again, it's myself, it's Don Kaufman, Jeff Bierman, Tony Rago. It's Greek week, but you have access. It's an all-access pass to TheoTrade for the entire week. You can view all of our archive coaching sessions, all of our archive chat room sessions over there, and of course you can view the live Greek week. This will also be recorded so you can watch it on demand. The entire week is $47. And again, read through some of the bullets here. Again, how to use delta to minimize risk, how to understand everything from delta hedging, and that's what really drives markets today. So even if you're not, necessarily like delta, gamma, theta, vega, by the way, delta, gamma, theta, vega does not necessarily just pertain to options, whether it's stocks, whether it's options, whether it's futures. Again, you're going to understand what really drives the marketplace out there. We're going to have discussions, very, very detailed discussions. When I say drives the market, why delta and gamma are the most important things to worry about, because that's really what's moving the S&Ps. That's what's moving the Nasdaq on a day-to-day basis. Top of it, we are going to talk very, very specific trade ideas, what strikes, what expiration period to ultimately circumnavigate, for instance, well, specifically into options, time value. We'll teach you to circumnavigate a little bit of time value over there. Again, all of it has unlimited access. I know that not everybody can join us live. Again, you will have an all-access pass to our live chat rooms from Monday, July 10th through Friday, July 14th. You'll also be able to go in there, though, and view our archive session. Now, our archive coaching sessions, you pretty much name a topic, okay, and it's in there. So you'll be given ultimately a pass into TheoTrade for an entire week. You can binge watch, just like on Netflix, umpteen different sessions on expected move. In addition to it, we're also providing a couple of bonuses there to prepare you for Greek week. Options 101, Options 201, Vertical and Calendar Spread Essentials, and Options 301, Volatility and Expected Move Essentials. Okay, again, last but definitely not least, I do want to show you just quickly, this is what our chat room looks like. This is the video screen. This is the actual chat room down below. But you'll have access to, you can come right over here to Member Home, and it's a full searchable archive. Okay, everything from TheoTrade tutorials. Okay, you can come in here though and start typing in, for instance, expected move. I need to know everything there is to know, Don, about expected move. There you go. Options 401, expected move. Okay. Fading expected moves over here. Another coach is into the extremes of expected moves. You pretty much name a topic and you can search for it. If you're into technical analysis, type in Fibonacci's. Okay. If you're into pretty much anything that you can dream of is covered. Futures. All right. It's covered right there on TheoTrade. Again, join us throughout the course of the Greek week. It's only $47. It's TheoTrade.com/Greek. Now, let's get to the weekend video. TheoTrade weekend video for July 8th, 2017. It's Don Kaufman. Well, we had a shortened holiday week and we saw some decent amounts of volatility throughout the course of the week. Of course, we really only had a half of trading day on Monday. Of course, Tuesday, July 4th, we were closed. And Wednesday, Thursday, and Friday, again, decent bouts of volatility. When I say decent bouts of volatility, I recognize that where we started the week is precisely where we ended the week. Now, let's start by looking at the S&P futures in this kind of weekend update. Again, I want to just briefly go over some of the price action that we saw last week, and then I am going to go into a number of individual stocks and ETFs that I think are really some good opportunities right now. So I'll start with the S&P futures. And the reason I'm starting with the S&P futures, I've been talking about two very specific levels in the S&P futures for quite some time now. In fact, there's a number of videos we've done in these evening videos mentioning these levels. Those levels, once again, happen to be 2411. And this is, again, specific to the S&P futures. 2411 on the upside, we have 2438. And what you're looking at in this circumstance over here happens to be a 30-day 1 hour. And it's pretty clear that, you know, we're bouncing in and around these levels. So as you start to zoom in on this trading week, okay, that 2411, again, this is not about support and resistance. This is about understanding that market-making firms and proprietary trading firms, they all carry these massive amounts of delta and really specifically gamma risk, okay? And the structure of their trades drive pricing in the S&P futures. In this case, you can identify over time levels unto which we'll get driven to. And specifically, we get driven to these areas of, like, for example, 2411. It's kind of the happy place for risk. And think of this not as support and resistance, but it's where these trading firms will ultimately perpetuate very, very limited risk. So we kind of get drawn into those levels. We meander around the level. When we come off of it, we explode higher or explode lower. Again, look at it more, if you will, as almost like a door and a gateway. We'll sit here and we'll channel around this, but again, the door can swing open. You know, the door can actually swing the opposing way. They're kind of concentric points where risk gathers. And you can see that pretty clearly when you're looking at again, this 30-day, you can see that, but even longer durations. And I think this is one of the most important things, is explaining why the market does what it does over here. And looking at this over a longer duration, this is now a 90-day 1 hour. And you can see ultimately this risk coming into play. I mean, we're going back here into late May, all throughout the course of June, and bouncing back and forth between these levels. And the reason I brought that up is the irony is, where do we end up? Right smack between 2411 and, of course, 2438. Now, as I said, some decent amounts of volatility in this week. And for this, I'm going to go over to the SPX, and I'm going to kind of zoom in for a second on the SPX. Again, the hash marks on your screen, those happen to be none other than the expected moves. So in the shortened holiday week, the expected move in the SPX is pretty substantial. But as I started with today, I wanted to show you specifically where we began the week, and I'm going to kind of mark it here on this chart, and where we began the week, which is right here, okay, is ultimately where we ended the week. I mean, this line, this central line is, you know, where the previous week ended, and this is where this week's going to start. All right, so what are we for the week? Massively unchanged, but that's in reference to the S&P. And the S&P has had a lot of weeks where we've, you know, moved around quite a bit and ended up relatively stable. Now, let's go to the Qs, the Nasdaq, because the Nasdaq has continued, and you can see these highlighted candles here. All of those highlighted candles are us exploding outside of the expected move. Now, even 2 weeks ago, we exploded to the downside, outside the expected move. Now, if you look at last week, and again, the holiday week of trade, so here is precisely where we started the week, and here is precisely where we ended the week. So for the most part, what do we see? Absolutely nothing in terms of trade, other than we got a little nervous there on Monday. We felt a little bit better on Wednesday. But wait, we sold off what? Thursday and Friday, we rallied right back up. So all of this is not for nothing, all right? We've gone out now and we've constructed a strategy that has been very, very viable in selling premium. And that is, we've been selling premium in the spiders and turning around and buying premium as the hedge inside of the Qs. And even though our Q trade didn't work, okay, which we don't expect it, it's a hedge, okay, the spider premium sale in this tetrapod spread has in fact been working. And we've had, again, multiple weeks of success back to back over here using this tetrapod spread. Okay, switching gears a little bit here, let's start to talk about the coming week because, again, that's what matters in trading. What matters in trading is, hey, hindsight is always 2020. Oh, well, we didn't move last week. Newsflash. Most of the time we do much of nothing. All right. And I say that, but, look at the S&Ps and specifically look at the S&P futures. When I say most of the time we do much of nothing, well, here's the S&P futures from there's May 25th to ultimately right now. From May 25th to right now, what have we done? Absolutely nothing. I mean, we're talking, again, a handful of points inside of the S&Ps. And that's why, we're kind of constructing strategies to sell some premium. But we're a little nervous as markets are throwing off some signs of volatility right now. Okay, so switching gears, I like to be forward-looking. I want to be forward-looking. A few things you have to be aware of. Number one, in this coming week, so there's a G20 summit coming up, right? Everybody knows about it. Everybody knows about it. Is it being priced into markets? That's something you have to ask yourself. Is the G20, there's a lot of risk in there. I've been hearing that for umpteen days over there. Oh, the G20 is coming and, it's got a lot of risk. Really? Really? Have you looked at the S&Ps? Okay, look at the SPX, a 5% volatility, a 7% volatility. The entire week, okay, has an 8.59% volatility. I mean, come on. We've seen the markets moving around. We had a 20-point sell-off, okay, last week, and yet the entire week holds about a $23 expected move. Just, again, perspective over there. It doesn't matter what people think, okay? In the marketplace, you don't vote with a hand, and you definitely don't vote by, rhetoric and with your mouth. You vote with your wallet. And that's what these implied volatilities are. They're supply and demand. So, everything aside, you gotta block out all the noise and realize that's about a $23 expected move. That's what matters in this next week. So we start the week right here in the middle of our range. That range again is right now we're at 24.25, and it takes us up about $23 and down about $23. I mean, the irony of this, and there is a pretty good irony over here. If we're starting the week right at 24.25, the upper end of this takes us just shy of 24.50. The lower end of this takes us almost to 2400. That, once again, is the expected move. People always ask, well, what do you expect? Well, frankly, I'm selling premium in the SPX and the spiders, so that obviously if I sell premium, I think we're staying inside of this expected move. Then I've turned around and actually bought some premium in the Qs in this tetrapod spread. Speaking of the Qs, we'll zoom over to them. The Qs have their volatility is contracted a bit from the previous week. And it's important to note, not only did the volatility contract in the NASDAQ, but the NASDAQ last week only, again, had 3.5 days of trading like the rest of the marketplace. So the volatility is contracted and has 5 full days. So the volatility is actually contracted quite a bit. We're only looking at a $2.29 expected move in the Qs, which is, considerably lower than we've seen. Again, about $2.29 for an expected move over the next 6 days. All right, so we got through some of the expected moves over there. There is one thing that is a little bit surprising to me, and now I'm going to take you to the XLF. So we're going to go through and look through a list of different ETFs and a couple products where I think there's some opportunity in the XLF. So this one surprises me a little bit because the XLF, the earnings season is upon us. So we're kicking off earnings, and it's funny, whenever earnings kick off, Alcoa. Nobody's looked at that stock ever, but Alcoa always signifies the kickoff of the earnings season. For me, the earnings season really kicks off with the banks, right? And the banks are going to kick off earnings this week. And the reason I said I'm a little surprised because the volatility is not that high inside of the XLF. I started looking through the XLF a little bit this morning here, and the contract size in there, though, it's pretty deep. I mean, we're doing almost 200,000 contracts yesterday inside the XLF, but you're going to see earnings late in the week from the likes of JP Morgan. And again, their volatility is not by any means jacked up. I mean, this is not the latest, greatest technology stock, but you can see JP Morgan, ooh, 23% implied volatility, you know, ooh, scary. It's not. Being a little facetious with that one. Bank of America, okay, is the following like Monday, Tuesday kind of time frame. But again, we are kicking off some earnings, the bank stocks. Now, the reason I bring this up, most of the time I don't talk in depth too much about the earnings, but I bring it up because many of the banks have big time exposure right now into the bond market. And the bond market has been absolutely tanking. However, okay, the bond market tanking right now is in the current quarter. However, I do believe that we're going to hear about some trading losses depending upon what bank it is. And I'm telling you right now, you're going to hear about trading losses in some of the major banks. Why do I say that? Because the bonds have really, in the previous quarter, they were a one-way ticket to the upside. And we all know that many of these banks, okay, had taken hits. Specifically, Goldman Sachs talked about it, that they took a lot of bond risk over there. So we could see some pain inside of the banking sector. There's an irony, though, behind that. And that's if, you know, Goldman Sachs is taking pain, maybe Morgan Stanley's on the other side of their trade. It literally is, you know, a two-sided market, you know, and again, the banks, they placed their very largest bets inside of this market over here, either the ZB or specifically the ZN. And it's interesting to see because, again, in the previous quarter, the bonds rallied. They may have made a lot of that back, though, in just the last couple of trading days as the bonds sold off. All right, so that's a little bit about the XLF. Next, moving on, XLE. Opportunity knocks in the XLE. I've been talking about this. The XLE, I want to make this very, very clear. I am establishing a longer duration position in the XLE. I have been selling puts in the XLE. Okay. Now, in these positions, I'm selling puts. I'm usually about 2 weeks out and selling puts, and you can see I've got a position here already. The puts that I'm selling are slightly out of the money. I want to get put the XLE. Now, do I know if this is a bottom? Absolutely not. Neither do you. Okay. But you can't sit there and wait. And when you open up like a 3-year chart, you're like, oh, it's scary. It's not that scary. The lowest point in the last 3 years has been $49. And this is when oil was getting absolutely decimated. It literally was getting decimated at that point. And it was like, oil's out of business. But, you know, you look at a 10-year, hey, listen, in my mind, you know, oil has probably already seen its heyday. And oil, you know, services and oil stocks are probably in decline. But if you look at this over like a 10-year monthly, right, these are months. It has not had an up month over here. And that's exactly why I'm going to go out and I'm going to sell some puts and I'm going to establish a longer duration position. I want to be long the XLE, but not for like a day or two. All right. This is for months, even possibly years in that position. All right. Moving on from XLE, let's flip around to something a little bit different, a little bit unique. Let's go look at Tesla. Okay. Why bring up Tesla over here? I am short Tesla. I remain short Tesla. I've got I don't know, 24 emails about Tesla. You know, what's it going to do? All right. I'm short. Again, I don't vote with a hand or the mouth. I pretty much vote with a short position. And I was kind of poking fun at myself the other day. I'm only short, legitimately short 100 shares in here. And even the 100 share position, this is a wild underlying. Hey, days where I was getting, you know, $2,000 and $3,000 P&L swings on being short 100 shares. Anyway, I'm going to remain short. I fully expect a bounce, okay, and then another drop. And I expect that bounce based on the fact that the implied volatility is really starting to get jacked up inside of Tesla. So you can see the IV percentile. If you're not in that position, okay, it's okay. It's like, oh, I missed it. I missed you didn't miss anything. You're going to get a bounce, short the bounce in Tesla. That's it. I mean, short the bounce in Tesla. You do have earnings to contend with in early August over there. We're going to look for a bounce opportunity, though. Next, EEM. I still maintain a short position inside of EEM. I think this is extremely advantageous at this point in time. EEM has a lot of exposure in a number of fronts. How really it's interest rate sensitive, and you see the interest rates in just the last couple of weeks are rallying again as the bonds sell off. You're actually going to get the EEM. I'm surprised the EEM is holding up as well as it has been. Again, I'm looking in a short position. It's a little bit more of a duration position. I'll have you note though, EEM, if you haven't ever looked at the option volume in here, just so everybody's clear, this is one of the heaviest traded individual ETF products on the street, period. And nobody seems to look at it. Give it some love, because all the other institutional and professional traders, they're all over it. EEM is a big one out there right now. Again, I'm establishing and have established a short position in EEM. All right, coming into Costco. Let's go to Costco. I've been talking about Costco forever. I maintain a short position in Costco. My position is a lot smaller than it used to be because Costco obviously shot to 180, took some serious pain. Most of that, though, even though I have a smaller position, has been gathered back. We're back into the mid 50s. I maintain a short position inside of Costco. Once again, a similar circumstance. The underlying has been beaten possibly to death over here. I think it's got a little bit more room to the downside before a bounce, but we might get another opportunity to short into Costco on a bounce over here. Last but definitely not least, in terms of the stocks I'm looking at, here's a longer duration position. And again, I'll always kind of exemplify a longer duration position. I have talked about silver in the past, and I sold puts in silver right back in this neighborhood over here. By the way, I don't know if this is the bottom, okay? And people are like, oh, did you know it was the bottom over here at 15? No, but I have pretty much marked anything that breaches the 15 marker inside of silver, okay? I start selling puts. I will be establishing a long position in silver. I think this is much more advantageous. I know there's a lot of gold bugs, right? Everybody's talking about gold this and gold that. If you look at gold though, over like a 3-year, all right, I get it. But then is it advantageous? Maybe, okay. But silver on a percentage basis, this looks far more advantageous to me. So I'm establishing a long position. Again, it is a longer duration position. Last thing I want to discuss, albeit briefly here on this weekend update, volatility. It's rocking a little bit. All right. We saw even in the holiday trading sessions, like the VVIX, it's getting lit. Now, the last couple of times the VVIX got to these levels, all right, there was the French election. There were wild moves in the NASDAQ. Here, again, we're seeing some wild moves in the NASDAQ. However, the volatility, this is the volatility of the volatility index, has gotten a little bit, aggravated. And this is something you want to keep an eye on. Above like 100, it starts to get serious. Above 1010, put your helmet on. We're going in. The VIX as well got a little bit heated up. And it's just something to keep in the back of your mind. By the way, the ultimate irony, I guess, of this session here, the VIX got heated up. It got all the way to 12. Be still my heart. Again, being a little facetious over there, because when the VIX used to get heated up, it'd be, over 25 and the 30 handle. Here we see the VIX at 12 and we're almost getting excited about it. Nevertheless, volatility is back. Volatility is absolutely in play. The one thing we have not seen, okay, and you very will likely see this, okay, the S&Ps remain in an incredibly tight trading range. I mean, you can pretty much set your watch to it, 2411, 2438. Be on the lookout. All right. Be on the lookout for us to start to crack these ranges. All right. Ultimately, I do maintain an overall short position in the marketplace. And I do that clearly because, as I said, I don't vote with the hand or the mouth. I vote with the wallet over there. And I believe that the S&Ps have been incredibly resilient, but that a break is coming in just the next couple of weeks to the downside over here. Thanks, everybody, for joining us at TheoTrade. Have a wonderful weekend. Bye-bye.